Hello everyone, you're welcome to my channel Promotion for Sure. In this video, we are going to talk about an important module D of Advanced Bank Management of Credit Management. This video is going to be a summary video of the entire module. It's a very important video in which you will get the entire summary of the entire module. So if you want to get a PDF copy of this PPT for quick revision, you can click in the link mentioned in the description box below. Now, if you have clicked to watch this video, be rest assured you have reached a channel that will give you a treasure of knowledge, and that's a promise. So please subscribe and become a lifetime learner. Now let's talk about financial statements. The profit and loss account and the balance sheet are interrelated and not independent. The balance sheet shows the position of asset and liabilities of business enterprise as on a given date, whereas the profit and loss account shows the profit made or the loss incurred by the enterprise for a particular year. The balance sheet for two or more successive years will show the change that has taken place in the asset and liability and the net change, increase or decrease in the net worth during those years. The profit and loss account is as valuable a source of information as the balance sheet, and at no stage it should be given a secondary place in ascertaining the financial solvency and strength of an enterprise. Since the trend of profit is the best indicator of prosperity of an enterprise, and the value of assets depend largely on maintenance of business as a going concern. Although the position of net profit or loss can be ascertained from study of balance sheet, it is only from the study of profit and loss account that we can ascertain as to how the profit and loss has been made, the factors or reasons behind such profit or loss, and the significant features of its constituent item. The profit and loss account is based on the accrual concept in accounting. Now, what to be taken and what not? Items to be taken into account: income relating to the accounting period which has been earned but not actually received. Expenditure which has been incurred and relates to the accounting period but not actually paid. Items not to be taken into account: income which has been received but not earned, that is, which does not relate to the accounting period. Expenditure which has been incurred but does not pertain to the accounting period. Now, who are the users of financial statements? The management of the enterprise, investors or shareholders, creditors, employees, government agencies, tax authorities, lenders, that is, the banks and financial institution. Now, what is the need of financial analysis? For technical appraisal, commercial appraisal, financial appraisal, economic appraisal, management appraisal. Now, what is financial ratio analysis? Now, ratio is an arithmetic relationship between two figures. It can be expressed as percentage, fraction, and proportion. These alternative methods of expressing relationship between items which should be related to each other are, for the purpose of financial analysis, referred to as ratio analysis. So interpretation is drawing conclusion to serve as basis for decision and action. So need for comparison of ratios. It reveals the relationship in more meaningful way, which enables an analyst to interpret them judicially and intelligently, draw inferences or conclusions. Such inferences can be drawn by comparison. Types of comparison: trend ratios, intra-firm, inter-firm comparison, ratios of enterprise with the average or standard ratio of the industry. Comparison with related facts is the basis of ratio analysis. So how to go about it? Balance sheet, trading, manufacturing, and profit and loss account, various schedules related to assets and liabilities, particularly the debtors, creditors, loans, advances, stock provisions, term loans, and deposits, including unsecured or subordinate loans. Report of the auditors in the prescribed form, report of the directors if it is a company, details of contingent liabilities, details of interest on term liabilities payable within 12 months from the date of balance sheet, details of old or slow moving or obsolete stocks, unrecoverable debts, and advances giving a long term basis. So, four groups on the basis of their functions. Liquidity ratio measures the short term stability of an enterprise. Leverage or capital structure ratio indicate the relationship between debt and equity. Profitability ratios measure earning success. Activity ratios measure the efficiency of asset management. So this is one example which you can pause and see, and you can. The formula is current ratio, current assets upon current liability. Test ratio is current assets minus inventory upon current liabilities. So interpretation is the higher the current ratio, the larger would be the amount of rupees available per rupee of current liability. In other words, the ability of the enterprise to meet its current obligation is more, which indicates that the safety of fund of short-term creditors is greater. But be aware, very high current ratio may be the result of stock management practice. So current ratio should therefore be seen in relation to the components of current assets and their liquidity. Now, asset test ratio or quick ratio, it is the refinement of current ratio. It takes into account the quick or more liquid current assets and current liabilities to determine the quick or instantly liquidity position of an enterprise. The ratio concentrates on cash, marketable securities, and receivables, net of bad and doubtful debts in relation to current obligations. It is more rigorous and penetrating measure of the liquidity position of an enterprise than the current ratio. So this is one calculation which you can see. Now, turnover ratio to determine how quickly current assets are covered into cash. There are three measures: inventory turnover ratio, debtors turnover ratio, and creditors turnover ratio. Inventory turnover ratio is dividing the cost of goods sold by average inventory. Cost of goods sold is sale minus gross profit or operation stocks plus purchase. Average inventory is opening plus closing stocks divided by 2. Indicated number of times inventory is rotated in an A. So if the ITR is 6, what is the interpretation? Inventory turnover ratio, you can take one example. Debtors turnover ratio, it shows the relationship between credit sales and debtors of an enterprise. Speed of realization, net credit sales divided by average outstanding debtors. Credit sales is equal to gross credit sales return. Debtors turnover ratio is net credit sale figures may not be available, bad and doubtful debts not to be excluded. Okay. Interpretation, efficiency of realization, short collection period preferable. Debt collection period ratio indicates average period of realization. Credit turnover ratio, creditors turnover ratio, it is the number of times the creditors are paid vis-a-vis credit purchases. Speed with which payments are made to creditors for purchase made on credit basis. Dividing net credit purchases by the average of outstanding creditors, net credit purchases are equal to the gross credit purchases less return to the suppliers. So this is how you can calculate the creditors turnover ratio. Leverage upon capital structure ratio. Okay. Now, two aspects of the long-term solvency of an enterprise. Regular payment of interest on the loan as and when due during the period of the loan. Repayment of principal amount of the loan in predetermined installment on the due dates or in one lump sum on maturity. So two different but mutually dependent and interrelated types of leverage ratios. So the ratios of first type are based on relationship between borrowed funds and owner's capital and are compared from the balance sheet. The other types of ratios, also referred to as coverage ratios, are calculated from profit and loss account. So leverage ratios are debt equity and debt to capital. Debt equity has two approaches: long-term debts divided by equity and total debt divided by equity. So debt equity ratio is also called debt to net worth ratio. So debt equity denotes the proportion of capital of an enterprise to its total debts. It indicates the relationship between own funds and the borrowed funds of the enterprise. So debt equity implications: pressure on earning of the enterprise leading to default on meeting debt obligations, possibility of the creditors losing heavily, interference from the creditors in management of the enterprise including close monitoring of the day-to-day operations of the enterprise. The enterprise might find it difficult to borrow additional funds. It would be possible only on restrictive terms and conditions at relatively higher cost. There is no ideal, however, capital interest intensive industries debt to equity ratio could be higher. So debt to capital ratio, these are three approaches. You can pause the video, you can go through it. Coverage ratios, profit and loss account, claims of creditors. Now measure the relationship between what is normally available from the operations of an enterprise and the claims of its creditors. So interest coverage ratio, dividend coverage ratio. So it is important from lender's point of view, shows how many times the interest charges are covered by earning before interest tax, out of which those will be paid. Now important from lender's point of view, dividend coverage ratio. Why profit after tax is here? You can profitability ratio, gross profit margin and net profit margin. Net profit margin is net profit divided by net sales. It measures the overall efficiency of production, administration, selling, financing, pricing and tax management of an enterprise. Profitability ratio related to investment, return on assets, return on capital employed, return on shareholders' equity. Return on assets measured in terms of relationship between net profit and assets. Return on capital employed is profit divided by total capital employed. Return on shareholders' equity, return on total shareholders' equity, return on ordinary shareholders' equity, earning per share. Earning per share is dividend per share, dividend payout ratio, activity ratio, asset turnover ratio, capital gearing ratio. This is how you can calculate it. Debt service coverage ratio, DSCR, it is ability of an enterprise to meet its liability by way of payment of installment of term loans and interest thereon from out of the cash accruals. It forms the basis of fixation of the repayment schedule. So what is the interpretation? Along with cash flow indicates when the repayment of the loan should begin, how much should be and what should be the repayment period. Return on net worth, some scenarios. Importance of ratio analysis. What are several limitations? What is fund flow? You can take one example from this. Fund flow statement, distinction, cash flow statement. These are some of the MCQs which you can pause and you can practice. So I hope this video would have given you a lot of valuable information and insight to this important chapter. So if you like this video, you can press the like button, subscribe to our channel and share it on social media. Help us to spread education in this beautiful world. Thank you.